The gross national debt of the United States recently crossed the $39 trillion mark. That liability is now so massive that it completely eclipses the entire economic output of the country. This is a global problem. United States debt serves as the primary risk-free asset for the rest of the world. Treasury bonds act as the ultimate safe collateral, securing trillions of dollars in daily international transactions. If the U.S. government defaults on those bonds, global credit markets freeze, banks fail, international supply chains break down, and a global depression follows immediately. Facing that math, lawmakers find themselves in a deadlock. Neither side wants to raise taxes or cut spending. Instead, they have started searching for painless escape hatches, radical theories promising to erase the deficit without angering the voters. But relying on these untested theories is highly dangerous. Attempting a fiscal magic trick to erase the debt could easily trigger the exact global collapse lawmakers are trying to avoid. The first proposed solution looks backward. It assumes the U.S. can naturally outgrow its current debt, pointing to the economic boom following World War II as proof. This chart shows the U.S. debt-to-GDP ratio dropping from 106% in 1946 all the way down to 23% by 1974. That looks like a blueprint for recovery, but the drop was driven by two hidden variables. First, the Federal Reserve artificially capped interest rates. Combined with post-war inflation, real interest rates were frequently negative. The government ran primary budget surpluses and silently inflated away the value of its debt. Second, there was a massive surge in the labor force. The baby boom and high immigration rates fueled an era of immense industrial output and economic expansion. Today's economy faces the opposite conditions. The population is aging, labor force growth has stalled, the federal budget is locked into mandatory entitlement spending for Medicare and Social Security, and real interest rates are positive. To replicate that mid-century debt reduction by 2055, the U.S. economy would need to grow at double its currently projected rate for 3 straight decades. The economic engine of the 1950s is gone, making this path a mathematical impossibility. The second escape hatch comes from modern monetary theory. It involves exploiting a legal loophole, originally written to allow the Treasury to mint commemorative currency. The idea is that the Treasury could mint a single platinum coin, assign it a face value of $1 trillion, and deposit it directly at the Federal Reserve. This gives the government cash to pay its bills, bypassing the statutory debt ceiling entirely. The flaw in this plan is inflation. Dropping trillions of unbacked dollars into the economy without a matching increase in real goods and services immediately dilutes the value of every existing dollar. This mechanism triggers hyperinflation, acting as a severe hidden tax on citizens. It strips the Federal Reserve of its ability to control prices and signals to international markets that the U.S. is printing its way out of trouble, which destroys the dollar's status as a global reserve currency. The trillion-dollar coin offers no actual fiscal relief. It is simply a mechanism for national currency self-destruction. The final theory claims the president already has the constitutional authority to bypass Congress and ignore the debt limit altogether, citing Section 4 of the 14th Amendment. Drafted after the Civil War, this clause was explicitly written to guarantee that the debt incurred by the Union could never be canceled or repudiated by a future Congress dominated by former Confederate states. The text mandates that the validity of the public debt shall not be questioned. Legal scholars point out that this creates a strict constitutional floor. It makes any attempt by the government to walk away from its authorized debts illegal. Rather than serving as an escape hatch to wave away the deficit, the 14th Amendment operates as a legal cage. It guarantees the United States must pay its obligations in full. The post-war economic engine cannot be replicated. Minting a trillion-dollar coin ensures hyperinflation, and the Constitution explicitly prohibits the government from walking away from the bill. The United States has backed itself into a corner. Decades of structural imbalances between spending and revenue have removed any possibility of a painless solution. Continuing to debate phantom loopholes only wastes precious time as the fiscal trajectory accelerates toward a breaking point over the coming decades. Lawmakers face a stark reality. They must enact difficult structural budget corrections, either by raising revenues, cutting spending, or both, before global markets permanently lose faith in the American dollar.